Hello, everyone. Welcome to the market update for Tuesday, December the 13th. If you have any questions during the week or any questions that I don't get to in the live class here, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. Crazy day so far in the market, but it's interesting how when we pull up the charts, this is why I love charts. It's amazing how price levels gravitate towards these areas. It also it makes sense with some things that were concerning me last week about the charts, and we'll see how it plays out. I still think one of the things I talked about last week that I felt like even if we do rally off of the CPI report, that it'll be short-lived. I don't know if that's going to be the case. Today's reversal is pretty significant, though, and it could still play out that we get this bigger drop, which is what I've been talking about for the last few weeks. The danger right here as a trader is that in my position, obviously I have these classes, I come on and people are listening to what my opinions are on the charts or the trend and things like that. The danger is that you can get locked into a particular bit of analysis to where you start to ignore what's actually happening. I made a pretty bold prediction. I felt like we were going to have a sell-off into the end of the year. Again, that can still end up playing out. But what if we start rallying from here? What if even with today's reversal, we reverse back up with the Fed meeting tomorrow? You got to be careful not to get locked into a direction to where you ignore what is actually happening there. What is the actual trend doing? Because that's when you really you lose big money is when you fail to recognize the direction. And our job as trend traders is to just simply let the market go where it wants to go, and we're going to follow along. Now, I do talk about events that are taking place and how I think the markets may react to those events. But again, as pure trend traders, we don't care about the noise. We care about what is actually taking place. And so now, if you're like me, you like to kind of dive into some of those things and hear the chatter of what's going on. I like to hear other people's opinions on what they think the market's going to do. But it's important, and that includes me. You could listen to my opinions, but the key is to focus on what is actually taking place. And that's what the software is really designed to do. Although, like I keep emphasizing, it's a bull market, designed to be a bull market software. Actually, it's designed to find bull markets wherever they are, and it does a great job of doing that. It's pointed out that the stronger sectors over the last 6 months has been energy. Energy has been a little bit weak lately, but it pointed us to those energy stocks to trade and to kind of keep us afloat during the bear market. And but like I said, it really works well when we're in bull market conditions, and we'll get there. I mean, like I said, I don't think we're at the bottom yet, but if we are and we do start to trend up, you'll start to find some great opportunities using the software, and I'll be pointing them out in class, especially the Thursday classes. We'll have a lot more to talk about in those classes. Well, let's take a look at the directional alerts, then we'll get to the charts. Again, there's not a lot the directional alerts are telling us right now, but they do become really relevant when we get to extremes. the momentum has been kind of in the middle the last couple updates. We're not overbought or oversold. Basically, this is telling us that we could go either way. It's not telling us direction. It's just saying that whatever direction the market trends, we could continue in that direction. If it continues to move up, we could move towards. We could keep trending up until this gets into the extreme overbought range. If it keeps going down, this could move into the extreme oversold range, and then that's when we'd have to worry about a potential reversal. Now, the other two indicators, and this is where we're getting a little bit of divergence in the indicators. If breadth is just barely off of the extreme, it's still high, but it is near an overbought area. What this tells me is that, and this is part of why I felt like if the market does rally off of the CPI report, that'll probably be short-lived, is that some of these indicators will be pushed right back into the extreme. Breadth, momentum is a little bit of ways from getting into extreme, but breadth would go right into there pretty quick. And then sentiment, like I said, it's still extreme. It's extreme complacency. I think that's part of why we're seeing the reversal today, is that a lot of times, and this is a weird thing, and this is one of those things that you can't really calculate, but it's one thing I've learned with watching sports and participating in sports, that it's a weird phenomenon where when something that looks obvious, let me give you an example. Last Sunday, there was a football game between the Dallas Cowboys and the Houston Texans. The Houston Texans only have one win. Dallas Cowboys had 9 wins and on the verge of making the playoffs. They were favored to win that game by I think it was over 15 points, which is a big margin for NFL games. You don't get that big a margin. And in other words, everyone felt like all they had to do was show up and they're going to win the game. Well, they did end up winning the game. Cowboys did end up winning the game, but it took a last-second drive to do it. They barely won, and they probably should have lost the game the way that game was playing out. This happens a lot when you can go back to, again, sticking with football, go back 10 years or so when the Patriots were undefeated and in the Super Bowl against the New York Giants, and it was just again, show up and they're going to win the game, and they ended up losing the Super Bowl. It was the only loss of the year. You see it happen a lot where something seems obvious or seems like the obvious move or it's a guaranteed move, and it doesn't end up happening. And I think with the CPI report that came out today, I think the first reaction is that the market's now guaranteed to go up. I keep hearing people talk about seasonality, and hey, we're in December. The market always goes up in December. You have the CPI report that's positive. This is guaranteed. The market is guaranteed to go up. And you have the sentiment extreme right here. Nobody's worried about a sell-off. And that's when these things tend to happen. Remember, what creates panic? What creates panic is not expecting what's coming, right? And then not being able to think rationally about what to do about it. I mean, think about times in your life where you've had panic, and hopefully you haven't had too many of those situations, but it's usually something that blindsides you and you have no idea what to do about it. And so you don't start acting rationally. Well, when I talk about panic sell-offs, you don't get panic sell-offs when people are expecting a panic sell-off. You get a panic sell-off when everyone thinks that there's no reason for the market not to go higher, and then it goes down, and you've got all these fund managers that are looking around saying, what does this mean? This is an ideal situation for a panic sell-off, because it's wait a second, this is a great CPI number. Why isn't the market going up? And then you have a big down day, and I'm not saying that that's going to happen, but if it does, that creates panic, and all these people, like I said, you've got these fund managers that are right at the verge of the end of the year where they get judged on their performance on a yearly basis, and suddenly the market starts selling off. They're likely just to sell to try to salvage a return for the year. And again, I'm not saying that that's what's going to happen here, but you've got the conditions that set that up. When you have this very, very high complacency and the market looks like it's guaranteed to go up, that's when you have to be careful. There's old Wall Street saying that when it feels safe to get in, it usually isn't. And now again, these are general statements. I use these general quotes all the time, general stock market quotes all the time, and most of them are very general, but there's wisdom in them, and if you can remember them and apply them in certain situations, I think you'll end up doing well, or at least avoiding a lot of the pitfalls that a lot of newer traders fall into. So we'll see what happens. Again, what really lines up there, and we'll talk about when we get to the chart. We look at the VIX, is that the VIX is very low, and we're bumping up against that resistance line on the trend, and it just has that feeling that, and then with a reversal like today, it just has that feeling like this is setting up for a drop. But like I said, to start off the class today, if it doesn't end up, if we flip-flop right back to breaking out of this range and going higher, I'm not gonna sit here and start continuing to go over reasons why the market has to go down. We'll start looking at areas to get into. In fact, there's a couple areas I'll be talking about today that we're going to start looking at again as part of the later part of the class. All right, buy-sell ratios, again, not showing anything extreme there. This sentiment indicator is in the middle, not showing any sort of extreme. And so, again, all these are telling us is that we could continue to trend in a direction, whether that's up or down. The market is not in any sort of extreme reversal, well, except for sentiment. It's not in any major extreme reversal risk area there. All right, let's take a look at charts. And remember, this price action is, this is where if you don't know how to read these candles, I talk about them all the time. I've got trainings on candle formations. If you go to the YouTube channel, subscribe to the TradersPro page or what have you, channel there on YouTube, and then you get access to those recordings. But I talk about them in class all the time. The market right now is showing that it's up. If all you're looking at is the market up or down compared to yesterday, the S&P is up 25 points, 24 points. About a 0.5% move up, but that's not showing the whole story. And if you don't know how to read the whole story, that's where you miss some of these opportunities. Here's where we open the day, all the way up here. Here's where we're currently trading down here. So we're up compared to where we closed yesterday, but we're down big time from where we opened. If that holds, then I don't know. Again, we still got a little over an hour and a half before the market closes. Could it be that the market rallies back up to those highs again? That's possible. But even that, the fact that it's going to take a lot of energy to push the market back up to those levels, that type of price action would tend to be exhaustive, meaning that it's not showing that there's a lot of active buying going on. And I think, a lot of times when the last time the CPI report came out, the market made this big move up right here. and it actually closed higher than where it opened. But one of the things I talked about the last time the CPI report came out was a lot of that buying, in hindsight especially, looked like it was short covering. Okay, market believing, a lot of the traders believing the market was going lower, especially after that down day right there. I was short the market with put options, believing the market was going to drop off of that. And then you got the surprise move. But after that surprise move, it lasted a day later, but then we didn't go anywhere. In other words, the buying that was happening was people getting out of their short position, and they were buying to close out those short positions. I talk about this all the time. That short sellers have to they sell first and then they buy back to get out of their positions. There weren't new buyers coming in to push the market higher. Now, again, I don't need to know why. It's just that, that's what was happening. Now, we did get a little bit of a burst right here. That was Chairman Powell's speech before he went into the quiet period ahead of this Fed meeting. And then what happened after that? It stalled. It went right back down. I think what happened a lot today, well, there was probably short covering right at the open, but there was a lot of short covering that happened yesterday. In fact, it's really suspicious that we had such a big move up yesterday ahead of the CPI report. I know that the stock market is rigged to some extent. That it is. Anyone that's been in trading, especially as long as I have, and seen the evolution, especially as it's gotten into the algorithmic traders, the computer trading going on, the front running, these brokers that offer no commission trades. Why? Because they're getting payment for order flow. They're selling the information of your trades. They sell them to these algorithmic traders that front run your orders, meaning when they see you buy, they buy before you do, and then it jumps up, and all they're looking to make is these fractions, but they do it millions of times a day to where they make a fortune. But it really, when you see that strong of a move ahead of a binary event like the CPI report, it makes you wonder if somebody knew something ahead of time. That's always suspicious to me when I see something like that. But the price action today, bottom line, the price action today is very bearish if that holds. Now, we did break out of the trend line, the declining trend line. We'll take a look at that here. Let's back out to a 2-year chart. We can see the trend line a little bit better. And I've been pointing this out for the last couple weeks. Now, on that last rally right up there, we went right to it exactly, and then we reversed back down. Part of the reason why I thought we were going to go straight down from there. Now, we opened above it, but here's where we're trading right now. So the fact that we broke above it at the open, although you do have to recognize that it did break that trend line. It hasn't broken above this line at any point since this is the last year around this time. This is when we topped out in, I think, beginning of January last year. So these aren't absolute. Doesn't mean that the market has to go down off of a reversal like today. But again, I'm just reading the momentum of the price action, and it's like, where are the buyers? This is supposed to be the news everyone's been waiting for, and the reason everyone's been waiting for to feel confident to go buy, and nobody's buying. That again, we're going to keep an eye on that this week. And now it could be that everyone's waiting for tomorrow's Fed meeting, but everyone knows that the rate hike is going to be 50 basis points, unless it's different from that. The Fed comes out and makes it 25 basis points. So that would be, I think, extremely bullish for the market. It's definitely not going to be higher than 50 basis points with the CPI numbers that came out today. Could it be that they're waiting for that to decide what to do? Yeah. Now, like I said, it won't be the actual number that comes out, but it'll be that news conference afterwards. They'll be trying to look for clues as to whether or not, what the Fed's plan is going forward with these CPI numbers that came in, with inflation showing that it's cooling a little bit. Part of the problem, though, is the bond market signaling a pretty significant recession that's looking like it'll hit us middle next year. And so, I don't know what you do as a Fed. You've got, you still have high inflation. You still have to slow the economy down, but you don't want to, this gets back to what I talked about before. The Fed would rather have a significant recession than inflation they can't control, because inflation is the trickier of the two to handle. They have a lot of experience pulling economies out of recession. Usually recessions don't last very long, but inflationary environments can linger, and you can get into a situation where you have stagflation, where you have slow growth and inflation, and that's really hard to get out of and to solve. And that's really what the Fed is really freaked out about, is something like that. So anyway, but like I said, it doesn't really matter what the Fed does. We could spend all day trying to speculate what that meeting's going to be like tomorrow. It doesn't matter. It's what happens with the chart. Where does the market go from there? And again, I didn't expect this big of a jump at the open. In fact, my first thought this morning was, when I saw the futures come out, the futures were showing the Dow opening up 800 points. And my first thought was, man, I'm going to look like an idiot, because I made a pretty bold call for a drop this month before the end of the year. And, I'm going to look pretty stupid, but, like I said, with this reversal, I'm not saying it's confirming what I still believe could happen yet, but it at least brought it back into the realm of possibilities again, with this bearish reversal today. So we'll see if it holds. Now, not all these reversals hold. They're usually stronger at the top when this happens. We saw it back here. There was that price action right here where it closed lower than where it opened, but higher than the day before. You almost always get some pullback out of that price action, but usually you'd like to see a big run up ahead of it, and that's not what we have here. You only have a little bit of a run up here, but like I said, you put it in the context of that trend line. You're back below that trend line, and then you look at some of the other indexes. One of the ones I want to point to is hitting the trend line. You look at the Qs here. And I talked a little bit about this last week, where I said, could we see the Qs rally up to that trend line? But I said the problem with that is, I didn't draw that very well. Well, maybe I did draw it correct. The straight drawing shows us right at it. Like it opened right at that trend line. But part of my argument against that was that it would probably mean the Dow would break out higher and the S&P would break above its trend line. But when you throw it when it's happening all in one day, where yes, SPY broke above the trend line, but it's right back below it again. This one opened right at the trend line, and it's down here now. The Dow broke out above it, but it's down. It's back below it. It might have just played out that way, where it did get to that area there, and you can see that's a Q chart. Let's go Dow broke out. Well, it already broke out above that. That was the Fed meeting there. It came back below it, opened above it, but it's back below that trend line. Now, these trend lines are going to be important over the next few days, because yes, we're back below them, but if we reverse back above them, and we close above them. Remember, today is not likely to close above these areas. We're not closing on a breakout in any of these charts, at least as of what we're seeing right now, unless there's a massive rally in the last hour and a half. But if we do close above them, we have to recognize that would be showing a break of that trend line. Now, not all breaks of trend lines hold, but that would push us to look at things a little bit more bullish if we can move back above those trend lines. So we're in a critical spot. We could really go either way still. That's why I'm not making a confident call, but I still think the market's going to drop. But I think it's significant that it's happening in this area, this declining trend line that, and you know, one of the problems that I pointed out before is that everyone can see that. Anyone knows how to read a chart has been looking at that trend line. And sometimes when that happens, the market will do some weird things to make it not so obvious or make you not so confident. And yesterday's market move was one of those days where it didn't make a lot of sense. Today's, like I said, I still don't have a lot of confidence that we're going up or down. And I think that's exactly what the market will do in those situations when everyone can kind of see where these significant areas are. It'll play around with that area a little bit and cause a little bit of uncertainty. The next step, though, is to see what ends up playing out after that. Where does it end up trending? And that'll be the key thing to look for. And hopefully we have a little more clarity on Thursday, because we'll have the Fed meeting done and the news conference done, and we'll have a little bit better idea of where we think we're going. Now, another thing, too, that to keep in mind is that, and I talked about the first time I talked about my expectations that we would sell off into the end of the year. It's also possible that we sell off in the first part of January. You know, you go back to that 1-year chart. Actually, you got to go to a 2-year chart here to see it. The decline in the market started in January. We rallied into the end of the year, and then we had this bigger decline in January. Now, it doesn't mean that every January you sell off, but you know, what makes January significant is it's the first earnings reports of the year. There's expectation now that we've had a few of these earnings cycles that we're going to see these companies lower expectations a lot more significantly, which again, that's part of the problem, is that the market's charging along like it doesn't see a recession in the forecast, where the bond market is screaming that there's a recession coming, and at some point where the market's going to have to factor that in. It hasn't factored that in yet, and that's, again, that kind of feeds into my argument that we still have a little bit lower to go before this is all done. All right. Yeah, there's just a couple comments here. Yeah, just dealing with the Fed. Yeah, there's something that we talked about, that the Fed is they're not going to say it, okay, but they want the economy to go into recession, because that's what's going to help deal with the problem. So if you think they're going to take their foot off the gas, so the last thing the Fed wants is the market to take off from here and just go up. Because, like I said, it's not going to solve the inflation problem if that happens. They're more likely to overdo it and go too far, slowing the economy down, than they will to take the foot off the gas too soon, or brakes. Take the foot off the brakes, I guess, too soon. You know, I guess you call that tightening, would be braking. All right. Take a look at Yeah, in fact, the Dow, I know at one point the Dow went negative. Like I said, the futures were showing the Dow up 800 points. It didn't open up 800 points. It opened I think it was like 600 or something like that, if I remember. I don't know, today's been kind of a crazy day, but now it's only up 55 points, but it did go negative at one point. We were down like 50, 60 points at one point. You can see right here where that was. I mean, that's insane. That is insane, a reversal. I don't know how you can look at that as being bullish. But you know what will happen is if we close positive, everyone will be talking about how the markets love the CPI report and markets were up today, and that's all the news channels focus on is did we close higher than the day before? And I'm telling you, if you can read the intraday price action and learn how to recognize that stuff, you're going to gain a big advantage over a lot of people out there that don't know how to read that, don't know how to see that. And it's obvious if you know what you're looking for, and it could cause you to make smart trading decisions. I wouldn't be buying into a day like this, at least not aggressively. All right. Get through the other charts here. Now the Russell, I think, is significant because it hasn't broken above any highs. It didn't break above the trend line. It didn't break above this previous high right here. It's showing a lot of relative weakness today, and it's also close to going negative where it's at right now. It's only up 0.5%. Bond market opened higher. It's trading lower than where it opened right here, but the trend, as we talked about, it looks like it's reversing into an uptrend here. And I think this low is important now because we did rally off that low. We break below that, it'd be a lower low. Something to keep an eye on there. Although it could be that this is just an ABC correction. That's another thing is you want to see when you think you turn the corner, you want to pay attention to the corrections. Do they look more choppy or sideways? This definitely looks impulsive. So does it look like that when it starts to pull back, does it look more corrective? That's a good bullish sign for bonds if it can do that. Now with today's move higher after this little drop right here, this definitely is starting to look more sideways. But again, it still could play out a little bit different over the next couple of days. There, we'll keep watching that, but it's still acting like an uptrend a trend reversal and a new uptrend in my opinion. And that's what I'm going to be focused on until it changes, until it shows me something different. Gold, talked about how bullish I am on gold. In fact, one of the areas I'm going to talk about today is as far as potential trades is the gold miners. I'm already in a gold mining trade, but there's others out there that you could look at. You could just trade the gold mining ETF, the GDX, but gold looks like it's turned the corner. It's now acting more like an uptrend. If the dollar continues to drop, that's more of a reason for it to go up. Like I said, as people start looking out there and looking for a safer return, they might start flocking to gold again, which they've avoided. And that's part of the confusing thing about the last year is when the inflation's high, usually gold takes off. We didn't see that. In fact, just the opposite. It declined this year. But I think the main reason for that was, yes, we had high inflation, but we didn't have a lot of fear in the market that there was a need to go to the safety of gold, go to the safety of bonds. And now we're starting to see that. We're seeing bonds take off. We're seeing gold take off. Some of these kind of safety plays that you see when professional traders are getting concerned about economic conditions. Oil dipped. We talked about how it was like, when it broke below here, it was likely to break below here, and it did. We've had a couple two-day rallies here on oil, and man, I've got mixed mixed feelings on oil, but you know what? I'm not the only one. You look at it back out, look at a long-term chart. I mean, whenever you see a chart that's moving sideways like this, back and forth, it's showing indecision. It's showing that traders aren't completely confident with the direction. You know, I was a lot more bullish on oil a few weeks ago, and my argument was that I felt like now again, the chart is what I base my decision on, and that's why I got out of my oil stocks. Okay, the chart started to break down, but I felt at the time that you know, how could oil not go up with OPEC cutting back production, China starting to reopen, and again, Europe, you know, weaning themselves off of Russian oil, needing other sources. How could oil not go higher off of that? But it kept dropping, and then, you know, I thought, well, I think I talked about a couple weeks ago that I know that Russia, knowing that this deadline was coming up, you know, fueled as many tankers as they could, because when the restrictions came in, it was on any oil that was already at sea could be dropped off. It was going to be, the ban was going to be on new shipments, and it's not a full ban. It's like a limit or something on what they could do. But they kind of flooded the market a little bit with oil, and so my thought process was, well, maybe that's why oil is going down, is there's still that you know, glut of oil out there. Again, now is the more I think the key here with oil is going to be the news on China. If China is if they don't go back into these COVID shutdowns, I mean, there's just obvious demand and need for oil, and I think that we could see another rally. Now, again, part of the reason why you know people are arguing that the inflation is down is because oil has been down. What if oil starts spiking again? You know, is that gonna cause inflationary problems to increase? I don't know, but I'm starting to keep some of these oil stocks on the radar. I'm really watching this move that's happening now. This is something I might address on Thursday, because if we continue to see oil push higher, I may jump back into some of these oil stocks. I don't like the way they were trading today, and with the way the reversal was today. And if the market starts declining, one of the problems is, especially if it's a big sell-off, it drags everything with it. So that's why I don't want to get too aggressive with new trades. But this is something I'm going to keep an eye on to see if now the key, I think, from a chart standpoint, what's most basic is you've got lower high right here, lower low right here. So if we continue to move up, and we continue to move up sharply, meaning this looks impulsive. This is an impulsive move down. If this looks like an impulsive move up, meaning if it starts to move more choppy from here, then it would look like a correction of that move down, and we're probably heading lower. If it starts acting more impulsive, and especially if it can break above this high right here. Now, it may not go straight above there, but if it moves up a little bit further and then has a little bit of a pause, and then keeps working its way higher, where this whole move looks more impulsive, breaks to a higher high, that would, at least in the near term, be more bullish for oil, and you know, that'd be if you wanted to add to oil positions, that'd be a stronger sign. Now, I may not wait for it to break above that high. If this has another day or two where it looks like it looks more like an impulsive move off the bottom there, I may jump into some oil stocks with some tight stops, and you know, see how they perform. But that's something to kind of keep an eye on. Like I said, we'll probably address that a little bit more on Thursday. The dollar continues to move lower. Now it does have a little bit of this is a little bit of a bullish reversal candle. This is opposite of what the candle looks like today in the markets. This opened lower. This is open down here, and it's trading higher than where it opened, but still lower than the day before. Now, how do I know this is trading higher than where it opened? Well, if it's gray, it's telling you it's trading higher than where it opened. If it's red, it means it's trading lower than where it opened. So that's a real simple way to see it right here on the charts, just the candles themselves. So now the trend is still down. So I'm not suggesting the dollar's going to reverse and go into an uptrend out of this, but it could have a little bit of a rally where it kind of fills in that gap and corrects a little bit and then continues to drop lower. I believe with today's move, I don't know, we're not quite in the extreme reversal risk yet, so it's not showing its extreme area there. The candles and these are very short term. The candle would suggest that there's a high probability we're up at least tomorrow from this. If it closes this way, that doesn't mean that it has to, like I said, start a new uptrend or something like that. But that's a little bit of a bullish reversal candle. We'll see what happens. See if it bounces a little bit off of that. It did the same thing right here. This is a bullish reversal candle right here. Opened down here, closed higher than where it opened, but still lower than the day before. You got a little bit of a bounce out of that. That's all I'm talking about. Is there could be a little bit of a bounce out of this, maybe just to fill in that gap. We'll probably have a little bit more. Well, we will on Thursday. We should be able to see what happened out of that move there. But the trend is still down. And again, this is a reason to look at commodities in general, because a weak dollar or falling dollar tends to be more bullish for commodities. Gold, obviously oil. It doesn't mean that it always has that inverse relationship, but it's when it is trending that way, it's one reason. It's an added reason for commodities to, when the dollar's falling, it's like a tailwind for commodities to go higher when you have a falling dollar. It doesn't mean it always does, but if you see a bullish chart on a commodity and the dollar is falling, it's more of a reason to trust that bullish trend, as long as that relationship is there. It's a confirming factor to that chart analysis when you see that. That's important. I talk about it all the time, but I get new people all the time. That's something that you have to know as a trader. Like I said, it doesn't always have that correlation, but usually commodities and the dollar are moving in the opposite direction, typically. And when they don't, you want to pay attention to that, because that could be signaling possibly something significant. Very much like the VIX has an inverse relationship. When the market goes down, the VIX goes up. Market goes up, VIX goes down. And when it isn't, when it's going in the same direction, you want to pay attention. I'm going to look at the VIX chart here, the VIX. Again, this is the ETF, and this is the only way to pull up the VIX and look at the VIX on the charting service, because the only things on this charting service are things that you can trade. And you can trade, if you want to trade the VIX, which I don't recommend doing, you can trade it through this I think it's an ETN. It's not an ETF, but same philosophy. It's a tradable instrument. It's the VIXY. But the problem with the VIXY is it doesn't always line up. It doesn't always move the same as the VIX exactly. So if you can access the actual VIX chart with another charting service, you can understand some of the numbers that I throw out there. And one of those is when you get down around 20, we got down below 20. That's showing extreme complacency in the market. The market has tended to sell off when the VIX has gotten down to that level. 30 is fear. When it gets above 30, it's telling you there's fear in the market, not panic, but fear. And anything above 40 would indicate panic. Now, these are general areas. It don't get too caught up with exactness when you're analyzing the VIX. But there's a couple of odd things that happened with the VIX. I got a few emails yesterday because the market was up pretty big, right? We had a 1.5% move, was it 2%? I can't remember where it ended closing percentage wise, but it was a pretty big move up yesterday, and the VIX made a big move up. And I got a lot of questions. Well, Jerry, what does that mean? Why is the VIX going up? Because usually when the VIX goes up, it means the market's going down. And what I tell you is whenever you see the market and the VIX moving the same direction, you want to pay attention. Now, what does it mean when you see the market up and the VIX up? Well, it usually means that the professional traders, remember, the VIX what we're trying to gauge from the VIX is what the professional traders are doing. They're the ones that, if we simply want to get out of our shares of stock, we can go sell our shares and get out. If they're trying to get out of millions of shares of stock, they can't just sell it all in one order or that tanks the stock, right? They're driving the price down on themselves. And so when they expect a big drop, they can't sell like you and I can. So what they do is they buy protective puts. They buy put options. It's like insurance. The put options will go up in value when the stock goes down in value. So it allows them to sell at their normal rate, the normal way they sell, or they can sell as fast as they want at that point, because it doesn't matter how far the price gets driven down. That put option is going to offset the loss, and they're protected. That's why they call them protective puts. That's why they call it kind of like an insurance policy. The problem is it costs money for that insurance, and these professional traders aren't going to spend that money if they don't think they need to. So what happens when you have an up day and the VIX is moving up? It tells me that they're buying protective puts. Why are they buying protective puts on a big up day in the market? Well, if there's no event coming up that you can obviously see, then it could be a signal they just don't trust the rally. That although things are, and you see this happen a lot at market tops, the market is overbought. It's still going up, so they still want to get into trades, but they're professional traders. They know that they're probably nearing a top. They don't want to get out too soon. And so in order to feel confident continuing to buy, they start to buy a little bit of this protection. Now, this protection is really cheap when the market is rallying. It gets really expensive when the market starts to drop. Okay, if you think about an insurance company, when everything's fine, they can't bump up the insurance rates because no one's going to pay it. They don't need it. Nobody feels like they need it. They won't sell any policies. But what happens if there's a dam break and everyone knows their house is going to get flooded? They're going to want to buy flood insurance, and now that insurance guy can charge whatever he wants, right? He's going to raise the price on it. Not that he would even sell it at that point, because he'd know he'd have all these claims. The point is, though, is that price of that insurance goes way up when the market starts to drop. And so that's the tricky part of what these professional traders are trying to they're trying to, they know they might need protection, but when they really know they need protection, it's too expensive to buy, or it gets really expensive to buy. And so a lot of times what will happen is when they get near a market top, they start to buy, and it'll show what's happening. You see the market going up, the VIX going up, that they're worried that that the market could drop, and so they're nibbling. They're not panicking yet, they're not in fear yet, but they're buying a little bit. Now, yesterday's move was a little bit more obvious. Everyone's focused on this CPI report that could cause a big move in the market, and it could be in your favor. If you've got a whole bunch of shares you've purchased and you can't get out of them all at once, you might want to buy a little bit of protection ahead of that event. And I think that's what was going on yesterday was those professional traders hedging a little bit. Okay. Now, I think it was a little bit, in hindsight, it was a little bit of a signal, because if they really felt like the CPI report was going to be positive and the market was going to take off, they wouldn't have felt a need to hedge or to buy it. Well, why would you buy that insurance if you really felt like that things were going to be positive? Now that we have the market gapping up and then selling off immediately, it makes sense. Somebody knew they might need some of that protection yesterday, and we'll see. We'll see if that is a signal that maybe we're going to see a further rise in the VIX. Now the VIX came right back down today quite a bit, but look how far off the lows it is. Well, again, a lot of this we'll see how it looks at the close. But if that VIX starts to continue to move up and stay elevated, it could mean that we see more selling. I think again, I don't know that we'll see a major move in the VIX until after tomorrow, when the Fed has their meeting and announcement and press conference and all that. That's something to keep an eye on too. You see the VIX start elevating, moving up, especially if the market is going lower and you see the VIX start moving up higher. That is bearish. Okay. Could it come right back down? And if the market breaks out of that trend line, I wouldn't be surprised to see the VIX come back down to 20. But there again, this is why I don't think that any rally is going to last very long, because you're right back into that complacency area and right back in the area where the market tends to sell off, right when the VIX gets down to 20. So it's just man, it's really hard for me to looking at these things to turn overly bullish just yet. Now, in a bull market, it's not surprising to see the VIX below 20 and stay below 20, and very often it goes lower than that and stays low for long periods of time. You go back and look at the VIX when we were, just a couple of years ago when we were in a bull market. Look, we were down at 15, 16, and we could stay here. It stayed that way for in that below 20. Again, there's 20 up here. Stayed below 20 for a couple months, so but we were in a bull market then. It's just the opposite. We've rallied to a trend line, and then we're getting the VIX readings down around 20. Usually you're going to get these sell-offs out of that when you see that. All right. Another thing, too, I think is interesting. Remember last week on the SMH, remember how I said that what worried me a little bit about the chart of the SMH was we were having a sideways move. Whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's likely to go after it's done moving sideways. It doesn't always have to do that. But today's move took care of that. It did go higher. It did break out of that range. That's all it needs to do based off of that. Again, it doesn't always go higher, but most of the time it will. It could drop from here after it's broken out. It doesn't, that saying doesn't mean it has to continue to move higher and break out to new highs from there. It just has to go higher from that sideways range. When it's moving sideways and the previous direction was higher, it should break out of that sideways range and go higher. And it took care of that at the open. That might have been all we needed to see in the chip stocks, and they could be reversing right here. So that's something to watch. I think that was significant because that's something I talked about last week as well. But then it kind of bothered me there. Same with that, again, that trend line with the Qs versus the SPY. And I thought, oh boy, if the Qs get up to that trend line, then the Dow and the S&P would break out of theirs. But today it solved all of it, where they broke out, but they came right back below it, and the Qs got to that trend line. There's a lot of just weird things lining up that to me are still pointing to a possible decline. Transports, I wouldn't read too much into what I'm seeing with that chart. Bitcoin, it still looks overall like it's going to head lower at some point. Now, so again, the conditions we're in, still a little bit of uncertainty, leaning still a little bit more to the bearish side based off of today. If that price action day holds, which it looks like it will, it should. But it was quick this morning where it dropped off of the open. Could it rally into the close in a big way? That's possible. But I just don't see it at this point of the day that happening. what are some areas that you could look at? I talk about the gold miners. You want to look at individual gold mining stocks. If you go into your sectors tab up here and you go under basic materials and click this little plus sign. So this is the general sector. There are subsectors within that, and you can see those subsectors when you click on that little plus sign. You see it breaks down into the different types of basic material. You got steel, you got iron. By the way, when it comes to mining, you got gold mining and silver mining and iron ore and copper. Most of the you got to be careful when you start labeling a company a gold mining company or a silver mining company. Gold mining companies go down and they're trying to find gold, and they pull up whatever's in the earth. It's not like if they're pulling up their silver down there, they say, "Oh, well, we're a gold mining company, so the silver we're not gonna pull the silver out, or we're not going to pull iron ore out because we're a gold mining company. We're not going to pull any copper out." So you can be labeled as a kind of a primary, usually gold is found in certain areas, so the majority of what you're pulling out of the earth is gold. But these are mining companies, and so they're pulling out whatever they pull out. And so just be aware of that all these mining companies they're mining for any valuable material in the earth. And so you got to be careful not to get too focused on the primary thing that they're mining. But you can go over under the gold mining companies right here. You can see that 12 of them have a buy signal right now. There's 30 of them that are at holds, and you can go look at the charts of these. Look at I tend to kind of focus on the ones I'm a little more familiar with. AUI Yamana Gold I'm aware of. They have a 95 strength rank. On some of these, because it looks like a lot of these are coming out of these large downtrends and kind of rolling over into the right side of that bowl-shaped move. In fact, let's take a look at Yamana Gold, and you can see what I'm talking about. The little one-year chart. A lot of these look like they're reversing from this downtrend into an uptrend. You got a nice little consolidation right here after a move up. It looks like it's wanting to go higher. And so you can on some of these you could if you could probably drop down into a lower strength rank. This one's still at 95, so this one's still pretty good. But if you look at some of the other ones there, I probably wouldn't go down too much further in there. But AEM right here is an 86 strength rank. Let's zoom into us. All these look like they're coming up the right side of the bowl there. Now the price action today is they're trading a little bit lower than where they opened, but it could just be they kind of fill in the gap from today, gapping up. I don't think that they could pull back a little bit. They've had a pretty good. So if the market sells off, they can sell off with it. But I like the fact that a lot of these look like they're moving up that right side of the bowl. So those are a couple that you could look. You could also go into the hold section. There's 30 stocks under the hold section. I like this Royal Gold RGLD. It was an 86 strength rank. I like it. This looks like a little ABC pattern right here. Like I said, it's a little bit of a bearish candle right there. It could maybe pull back a little bit. That's why we'll see how these look on Thursday. I don't know if I really want to jump into anything today. Now, also too is you don't want to focus on a specific one. Just look at the GDX. And this is probably what I'll trade for the portfolio when I get in. I already have a gold stock, mining stock in there, but you can just trade the whole group. You know, back out, you can see this is a nice little uptrend, or it looks like it's reversing into an uptrend. This is probably one that I'll get into and just kind of give it a little bit of a wide stop and just see if it takes off. A little bit of a longer term play there. And like I said, we'll probably look at some oil stocks too on Thursday. We'll see. I kind of want to get these couple days out of the way before I add anything now. The only thing I'm holding in the portfolio is, I'm down a little bit. I was in SOXS, the inverse ETFs, and the SARK. I got out of those at the open because I didn't know if we start to take off. I didn't want to. Again, the whole point of those trades were as a hedge, and I didn't have a lot of long positions, so it could really drop me if I held on to those. Now, I may jump back into one or two of them the way the market's kind of reversed. Let's see what let's look at SOXS. Yeah, because you got a little bit of a bullish reversal candle today where this could start to move up. I don't know. I'll probably. I kind of want to see how things go tomorrow. I don't want to be jumping into too many new bearish. This will go up if the market goes down. That's why we're looking at these. SARK had a big reversal, so I wish I would have held on to these because I got out down here in the this morning, and they've come all the way back up. I wouldn't have taken as much of a loss there but again, it's hindsight. It could be the opposite where you could have been way up, and I'm losing a ton of money with this. It's supposed to be a hedge, and it's not. So I may jump back into these, maybe just those two at the market close. The problem is, though, is I don't have a lot of long positions, so I'm not really hedging. Safer play would just be to stay in cash. So maybe I just get into one right now. And then if it looks like, the market could decline more, I'll jump into some of these, see if we can make some money when the market declines. But I haven't decided what I want to do with that yet. All right, that's all I have. Let's wrap things up. I'll take one quick look at the SPY before. Yeah, we come off the lows a little bit, but that's still a pretty big bearish reversal candle there. We'll see how it looks into the close, but and how it trades tomorrow. But Thursday, we should have both events out of the way and maybe have a little bit of clearer picture of what we're expecting over the next week or so, and then what decisions to make, what portfolio decisions to make at that time. All right, have a great week, everyone. We'll see you on Thursday for the stock-specific class. Bye now.